All right, ladies and gentlemen, I hope you had a wonderful weekend. Last week was absolutely insane in the markets. We had data, POW, earnings. Everywhere you look, there was an event. But now this week, it's actually going to be a lot calmer in terms of data. We still will be having the earnings, but now the broader factors, what's going on with China, what's happening with the bonds, they are definitely making their impact. So, Chad, we got a lot to talk about. I have the plays. I have the keys. All that good stuff. What I need from you, a thumbs up on the video. Make sure you're subscribed. And if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/the stock market. We will see you there in the morning. And don't let me forget, baby. Today is Sunday. Tomorrow is Monday. I got to pull it up here. I'm still logging in, but we have the random account generator. And what we ask on this watch list, you post a random play, option play, keep it below $100, post the strike price, expiration date, all that good stuff, and we are going to buy it. So we had a couple of hitters recently. The last two haven't been there, but Chad is done good. Here, let me find the chart. Yeah, this is it, man. So this is how we're looking. Not bad. This is random from the comments. So let's get it, baby. Run it.
Working to the couch, it's the 2020 election. Live in the hills, but I still get a spread. Started with a live, but I still reinvest it. Feel how I feel, then it feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down, hold it.
Right off the bat, before we get into the keys, we got a little bit of housekeeping in terms of what happened on Friday. So don't forget, we had the non-farm payrolls. They came in surprisingly lower, and yes, it was a sandbag because everybody raised it up ahead. It came in lower. I think if the number was like 170, if it came in what we were pricing in at the beginning of the week, it wouldn't have looked like that big of a beat. But what happened on Friday, it was a huge miss in terms of the jobs. The market liked it. It was already feeling good from Apple and Powell and all that other good stuff. But then intraday right here, you see how we kind of like sold off the rally. That was because of the ISM services, and it was showing once again prices going up and the overall index dropping. And if you don't know, ISM is considered one of the leading indicators of the economy. So this is from Bank of America, and why it's kind of important, because if you saw it on Friday and even at the beginning of the week, investors have really been responding to the ISM data, especially now that both of them are in contraction and the prices are going up. So we'll talk about that effect that it had, because sure enough, you had people talking stagflation and all of that, but we were able to close up green. You had a rally last week. People were feeling good, and it's not like you ended on a bad note after dodging the bullets from Powell down to earnings and even the non-farm. So keep all of that in mind. But now getting into key number one, like I told you, this week is going to be very calm in terms of data. There might be the SLOOS, or that may be something that moves us, the Senior Loan Officer Survey. That's going to be coming out on Monday or Tuesday, and that could affect some of the banks, and maybe we'll get something. Otherwise, it'll be wholesale inventories and other sets of data. It's not as if they don't hold any importance. Maybe they will be able to move the bonds, but compared to what we just got and the fact that the CPI is next week, I doubt that this is going to be the crazy one. The only other factor outside of the data this week, it will be the earnings. And this is something that I was saying since last week. It's borderline a school of fish. You're no longer going to get any of these crazy mega caps, except for NVIDIA. They're going to be in a couple of weeks, but here's just the overall calendar. There's a bunch of big names. Uber's giant, Disney's big. You're going to get airlines, a couple of oil names, couple of software names, even MPW, Warner. There's just so many big names that are important, but the size of these companies compared to what we just gone through, it will be a lot smaller. So what we are looking for is the general consensus of all of them. Are they going to act like a school of fish that gets the market scared or excited? So beyond that, the only other factor you got to keep your head out for is now these broader factors that we have been talking about. Obviously, the Kendrick one, that one's a little bit different, but there's two big things at play. Number one, you may have heard me say this, ABC, anything but China. We were just talking about this. I've had a bunch of these China plays, and we've been waiting for Wall Street to start pumping it up. Well, the fact is, after last week, I was telling you guys about all the little events and the bonds, and now after 2 weeks, this third week is about to be pivotal because people are saying, wait a minute, is the trade reversing? Are you watching now other nations, other economies in Asia go down, and now China's starting to bring it back up? But that big rally in China, people are starting to think as if things can change. So if this week doesn't have that much data and it's really not that crazy and we're getting ready for the CPI, if there will be a driver, I would keep an eye out for what China does, because this was now, even then, I gave you another screenshot about a week ago, 2 weeks ago. Well, to start off this week, you ended last week with one of the biggest fund flows into China in about 8 weeks. And the only other time, well, that was when everybody was getting hyped off pivots and everything else. So very big deal. We want to see how China plays out. I do think that will be another X factor on the day. And then the other one is ABB. So you may have heard me say this in an earlier video as well, but this one means anything but bonds, and that's why the market is holding up. But no matter what, people would rather own big tech, Magnificent Seven. They want anything but the bonds. The bonds right now are in a bear market. They've been down like 40%, I think, in the last like 3 or 4 years, and this is what Michael Hartnett from Bank of America was talking about, and his idea, and I kind of agree with it. He's pretty much saying the bonds will be in a bear market until the market gets rid of pretty much supporting fiscal excess, and you're going to get really vicious bear market rallies out of the bonds, but generally this idea is holding. So why I'm putting these two together, because if you have been watching these videos, we've discussed this from the beginning of the year, and now it's starting to look like ABC, anything but China, that will be able to turn this week if all is good. But this idea of anything but bonds, even though we're getting all this data and feeling good, we still have to digest a lot, but most people are still believing that there's something way bigger at play in the bond market, and it is in a bear market, and that won't change until there is a huge fundamental change. So very important. We've talked about this, and that's why even this week, calm data lead it into the big data. I can't wait to see what China and the bonds do, tied into everything else. So that is key number one. They not like us. They not like us. But then key number two. This is the weird part about Friday, and this is what I wanted to bring up to you. There are weird stagflation fears hanging around, but hopefully you see how quickly we are brushing it off. Not only was it the data on Friday, it was like Tuesday, we had other ISM data, and once again, prices rocket up, the sales plummet. It's the definition of stagflation, and people were even saying, depending on what happens with the job numbers, that could say a lot too. But if you don't remember what Powell said, I see no stag and no flation. So watch out for this narrative here, because depending on some of these other little sets of data, we want to watch here, even moving into the CPI, if this narrative gets anything built off of it, because there is data showing it, but the market is ignoring it, and even the Fed. But on top of that, the real thing I want you to understand with like, yo, why are we even bringing up stagflation, and why is the market ignoring it? Yeah, stagflation is important, but I need you guys to realize this right here, right now. You are finally starting to get data coming down. We didn't know how long it will take, and usually it's short-lived, but even the jobs, that came down. If that continues, if all of these indicators are finally moving different than what we've seen, people may get worried about it and bring up a lot of stuff, but it does kind of show us that we have actually been seeing a little bit of a change here, and I guess the markets and bonds follow that as well too. But that is key number two. Watch out for that. And then finally, like we talked about, man, equity catalyst and bond catalyst. That's what we needed on Friday, and quite frankly, I think if we see that this week, as long as bonds could do good along with stocks, that should be a bigger driver, because after last week dodging those bullets, I feel like there's a lot of room the market wants to make up, but I don't know how it'll take it if, once again, the dollar starts climbing, the yields start going back up. I don't know if the market will be as resilient, considering, well, the bonds are still kind of hugging that 475 or right near there. So watch out for that. Otherwise, if it doesn't give us too much from either bonds, stocks, and it really is a slow week, just be prepared to stay within that 5,100 range. We're a little bit above it now. We'll see where it sets us up. But then before you know it, by Thursday or Friday, we're really going to be talking about the macro calendar that comes the week later. But Chad, I hope you're ready for all of it. I hope you're excited. But now, let us get into the plays. So, right off the bat, I got a couple of different plays for tomorrow, and I'm actually kind of excited about this one. I spent a decent amount of money on this, and it had the pop, so we missed out on it, but I grabbed a July play on AMGN. I have the play written down here. Not a recommendation, but this low-key could be very big because they low-key have an obesity drug. So they had encouraging phase 2 data on Friday. I think it's called not like Manjaro, it's Filjar something, it has some weird name, but this is their GLP-1 drug, and it started to look good, and people got excited about that. Amgen is one of the, I think back in the day, they considered it one of the 4 horsemen of biotech. It's a gigantic company, so this was big news. If they're going to get into it, stock saw a jump. They also had decent earnings. I thought I'd make a play. They did have premium. It wasn't as bad, but you just really need people to get hyped up on this. So we'll find out how it plays out, but that was really big piece of news on Friday. Decided to make a play. Then play number 2. This one, you should know, man, Airbnb. They got earnings, I believe, on Tuesday or Wednesday. We had our play, and literally on Friday morning, they went green after being down like 40%, and then they dropped back down after the market chilled out. So I didn't think I would have my opportunity to average in the morning, but then by the end of the day, the premiums came back down. We were talking about this on the watch list. I did, in fact, go for the average on Airbnb, and I bought a May 17th 172.5 call at $2.80. And why I went near the money, this is a theme we were talking about last week, and even then, there's like 2 days ahead of this earnings. I'm playing it solely for the pre-earnings run, so by staying close to the money, I don't want to get clapped on the run up. Let's say the stock stays pinned. Sometimes those out of the monies, they'll start to get drained out, but the ones near the money, they will do a little bit better. So I paid a little bit more, took a little risk on the assumption, because I could end up being wrong on all that this will hold up a little better. So we'll see how it plays out, but that is play number 2. And then finally, the last one, man, gold. So I made a play on MGC on Friday. We will talk about it, but just in general, gold has been a very difficult asset over the last month, ever since it kind of ran $300 above everything with no real clear-cut catalyst. And even though everything walked back on rate cuts, gold still found a way to go up. So I'm a little worried in price, but I'm kind of down to start dabbling in it again. And we did make a play on Friday, and this is pretty much what I'm going to be looking for. We had all the data come in, and it was all data that was very supportive of gold going up. Stuff that would slow the Fed down, jobs coming down. That's good for gold if you want that rate cut. It was so bullish on gold on Friday, and then gold was down by like 0.9. So I made a trade on it. We got a nice $300 flip. It ended up working. So if I'm not confident on the price, I am going to keep this as kind of a idea in catalyst or driver, in the sense of if we're waking up and there's data on gold or even broader macro data and gold should be up and it's really trading down, I might be down for some of those flips. So watch out for that. That is play number 3. And then finally, moving into the rest, man, I don't know. You guys have been liking these too, so if you got any questions, let me know. But as far as what I did on Friday, I grabbed those Airbnbs and the AMGNs that I showed you. We flipped those MGC contracts. It was down like 0.9. I think I got it at like 23.90. Or like 22.90 or 22.80, and just sold when it went above 2,300 again. And then I grabbed 3 MCLs on oil. This is a micro crude contract. They fell below the 80. I haven't been able to play it at 79 in months. We've talked about it, so I went for one of those. Still down, I think, like 100 or 200 bucks from Friday, but we're going to be riding that out. Hopefully we get a bounce on oil, because I do think it was like a full 7 days, 5 days trading, and then the 2 days prior, it was like 7 days in a row of just trading lower. But other than that, still got a couple plays that we talked about, from the yen to the bonds, and then even like ARM and Intel. I should have put it up here, but I do have those ARM plays, and they have earnings on Wednesday, but we'll probably talk about that tomorrow. Other than that, though, I still got some questions over the weekend, baby, so I hope this could be helpful for all of you. Somebody asked me, Josh, is it time to load up on the REITs right now? So Let me see. I got to break it down here so you can see like all of it. But the answer is yes and no. I mean, especially after this video. I mean, think about what we were talking about, anything but bonds. The bonds are in a bear market right now, and they are going to stay there until Main Street, like voters and people and politicians and Wall Street, even the banks and the analysts and the Moody's, all of them, until both parties, I'm not talking political parties, but both Wall Street, Main Street, until they move to end fiscal excess. The way people are viewing it, and this is from Michael Hartnett at Bank of America, the way people are viewing this is just simply you have a bigger win that's hurting the bond market, and it is all just government spending and the lack of control there. And what we're doing, that's what's making it with, you could have a rate cut, you could have all these things, but that pressure in bonds, I mean, you haven't been down this much in like 40, 50 years. So until that ends, you're not going to watch the bonds come back. And now why that relates to the real estate, because think about it, the higher rates, it has been one of the biggest threats for commercial real estate. Or if the bond market's not functioning, bonds aren't doing good, yields go higher, all, even just getting funding, that is all problems for commercial real estate and almost every real estate. But then on the other hand, this idea that we're going to be cutting rates soon and that it's almost going to be over, even the fact we're finally starting to watch data turn, this is getting some people like, well, maybe we should take advantage of all of these discounts in the REIT space, especially if policy in the future will start to be accommodative. So the thing you got to understand with all of this is, like, right now, every single REIT is trading lower due to the pressure since we started raising rates. Even though the real estate market has been doing good for residential, most REITs, they've started to trade lower. They had some pressure by that shock we had to deal with bonds. So most REITs are trading at some level of discount, especially compared to their technology magnificent 7 peers. So that's the first thing you got to understand. But then the other part is how a REIT sets up their company. It's one thing to say I want to buy all the REITs broadly, but you really got to focus in on the structure in that portfolio. You want REITs that have low debt, low fixed interest on the properties they own, and no upcoming maturities. And these factors, that's what's going to change it all, because essentially if rates are going to help or hurt a REIT, it depends on how much debt do they have, the debt compared to the assets. If you own a bunch of property, let's say you have a bunch of debt, but if it's locked in at 2% versus 6 or 7, that tells us a lot about how you'll have to refinance or if you're holding a good deal or not. And then do you have to pay back money? All of these factors, that's what's going to make them good. But generally, I like the value, and I think things will be supportive, but I think there will be a lot of death for every one winner that comes out of the REITs. But when all of this is said and done and the dust does settle and we could get to a calm market, there will be a time where REITs, like you're going to look back at these prices and be like, damn. So hopefully that helps out. That was the first question. And then question number 2, they said, Josh, would you buy a CD right now or a 5-year bond? And no. So this is a wild one, honestly, because you have the idea correct, like getting fixed income, 4.9, 5%, doing nothing, that is great. And that's the idea that you should do. But the duration and then adding restrictions to it, that is what I would stay away from, because right now you could get 4.99% to 5.25 on anything. You could go make a Fidelity account. You could go buy Bill, like with literally no steps or one step. You can be getting a very high return of interest on any money that you are not using. So to lock it up or commit to a period of time, especially like a CD, and most of those CDs are offering the same rate, maybe a little higher than the 5.25, it's usually not worth it to be tied up in all of that when you could get way more freedom for borderline the same type of return. So that's what I'd say as far as CDs. And as far as bonds, I have a lot of real money in 2-year bonds. I don't go for the 5 years. And why this was a very specific question. They were asking 2-year or 5-year, but especially the 5-year. And I said, why would you go for the 5-year right now when essentially the yield is the same and the yield curve's inverted? But the general idea is that a 2-year to 5-year unless you want just the extra 3 years of that coupon. But even if rates go higher, I mean, a 2-year, you could kind of adjust into that. But the whole logic is that you're getting the same type of return with half of the commitment. So down the road, you're able to still lock in 2 years of a very good return, and then you still have time to reevaluate. You're not locked in a 5-year thing. So imagine 2 years, get your return, market comes down, you want to use that money, you'll be ready to go with a 2-year bond. A 5-year bond, I mean, it's hard to say what's even going to happen every 1, 2, 3 years. 5-year bond, you're not going to be able to pull all that money out without any penalties unless the bonds really rocket up until another 5 years. So point is, there's a lot of easy ways to be getting great risk-free stuff. You just got to tie it into your plan and what sort of duration. But if you're thinking anything about CDs, bonds, bill, really give yourself a talk on duration and ask yourself, how long do I want something and why, and what is your plan moving around that? So keep that in mind. That is question number 2. And then here's the last question. I actually really, really like this one. I got to go up here a little bit. They said, what happens to Jerome Powell after the election? So the answer is nothing. Even though we're like Biden, Trump, no, fake news media. It's a really, really big deal, but Jerome Powell, nothing happens after November. Powell will actually be done with this term that he's serving now in 2026. So in 2026, after he is done, it will be up to the president, whoever it is at the time, to either allow Powell to stay in if he wants to do another term or to nominate somebody else. So his job security in terms of the election is not really too big of a deal. But we've talked about this. Some people have argued that Powell wants another term, or other people have said we need Powell to another term because you want the guy who set out the plan to pretty much bring you through the whole entire journey. But if we are going to bring this up as a question and talk about this, the real issue surrounding Powell in the election right now is whether or not he is going to affect the election. Is the Fed essentially going to have some sort of weighting on the scale whether or not they cut rates or don't ahead of it? And right now, people are giving him a lot of crap. And I don't know if you guys saw the last FOMC. He was a little defensive towards this question. So Powell, the Fed, they really want to distance themselves from it. But depending on the actions that get taken as we get closer to it, we're probably going to see what happens. But then maybe, I don't know, maybe we go over the Feds during elections. Maybe that could be another question. But Chad, that is all I have for you. I hope you guys enjoyed it. I hope you get a great rest, and we see you in the morning. But it's about to be another crazy week, so I hope you're locked and loaded. But that is your watch list, ladies and gentlemen. Make sure hydrate, healthy, ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember you blessed, baby. Inherit it with the meekness. Stand on the right principles. But Chad, you got a long journey and you did not come this far for nothing. So I'll see you in the morning. Drink that water. Stay hydrated, healthy, all that good stuff. And horn.